Unlocking your financial future, why investing matters and how to start in a recent episode of Invest in Your Financial Future, a show by Times Radio and HSBC UK. Host Rosie Wright, alongside financial journalist Georgie Frost, consumer rights expert Martin James, and Can Chan, head of Premier Wealth at HSBC UK, tackled the often daunting topic of investing. The discussion cut through the noise, offering practical advice for anyone looking to grow their wealth strategically, whether for early retirement, helping children onto the property ladder, or simply making money work harder. Here's a breakdown of their insights and actionable steps to get started. Why do people hesitate to invest? For many, the idea of investing feels overwhelming. Georgie Frost highlighted that while some hold cash for practical reasons, like saving for a house or maintaining an emergency fund of 3 to 6 months' income, others are paralyzed by fear, lack of knowledge, or misconceptions about risk. A striking statistic from the Investment Association revealed that 1 in 5 people have never heard of a stocks and shares ISA, underscoring a widespread knowledge gap. Martin James added that even high earners often feel they need to be financial experts to start, which isn't true. The fear of market crashes or global volatility, amplified by media, further fuels hesitation. Yet, as Can Chan emphasized, this reluctance is common and no one should feel discouraged. The key is to demystify investing and take that first step, no matter how small. The biggest risk? Doing nothing. Frost pointed out a critical truth. The greatest risk is often not investing at all. Money left in low-interest savings accounts loses value due to inflation, which averages around 3.5% annually. To even keep pace, your money needs to earn more than this. Over time, historical market trends show that investments tend to grow, provided you stay in the market. It's about time in the market, not timing the market, Frost said, urging listeners to avoid waiting for the perfect moment, as global uncertainties, pandemics, wars, or political shifts are always present. Where to begin? Know yourself and your goals. Before diving in, the experts stressed the importance of self-assessment. Chan advised evaluating your financial situation. Do you have high-interest debt, an emergency fund, adequate insurance? If not, address these first. Next, define your goals. Are you saving for a 5-year plan, retirement, or your children's future? Investments should typically have a horizon of at least 3 to 5 years to ride out economic cycles. James noted that the perception of investing as complex or requiring large sums is outdated. You can start with as little as £50 a month, he said, pointing to HSBC's tools and apps that simplify the process. Automation, like setting up a regular savings plan, helps build a habit and smooths out market volatility through pound cost averaging, investing fixed amounts regularly regardless of market highs or lows. Understanding and managing risk is a major concern, but it's often misunderstood. Frost explained that younger investors with longer time horizons can afford to take on more risk, such as investing in stocks, which may offer higher returns but come with greater volatility. Older investors, or those with a lower risk tolerance, might prefer government bonds or low-cost options like ETFs, exchange-traded funds. Chan emphasized diversification, spreading investments across different assets, to reduce the impact of any single market downturn. Don't put all your eggs in one basket, he advised, warning against chasing trends like a single hot stock. For those prone to checking investments daily, James suggested a mindset shift. Investing is a long game, akin to test match cricket, not a bungee jump. If constant market fluctuations cause anxiety, you might be in the wrong investment or need to reassess your risk tolerance. Overcoming the first step. Despite the wealth of information available, taking the plunge remains daunting. Frost likened it to going to the gym. Everyone knows they should, but fear or procrastination holds them back. Her advice? Start small. You don't need to invest a lump sum. Drip feed your money to test the waters. Apps and wealth advisors can guide you, and platforms like HSBC's make it easier than ever to begin with minimal funds. Key takeaways for aspiring investors. 1. Start small. You don't need a fortune. £50 a month can kickstart your journey. 2. Diversify. Spread your investments to manage risk effectively. 3. Think long-term. A minimum of 3 to 5 years allows your money to grow through market cycles. 4. Know yourself. Align your investments with your goals, risk tolerance, and financial situation. 5. Automate. Regular contributions reduce emotional decision-making and smooth out volatility. 6. Seek guidance. Wealth advisors or user-friendly platforms can simplify the process. As Frost aptly put it, greed slams on the accelerator, fear hits the brakes. The goal is to find a steady pace, letting your money work harder to fuel your dreams, whether that's early retirement, financial security, or supporting loved ones. The first step is the hardest, but with the right mindset and tools, investing can become a powerful habit for your financial future. For more information, explore resources like HSBC's investment guides or speak to a wealth advisor to tailor a plan that suits you.